So let's talk about the economic outlook of Kenya, especially in the wake of the anti-government, anti-tax protests that swept this country over the past couple of weeks. Kenya has been undergoing very interesting times, and I think there is one quote that summarizes quite nicely the happenings that have taken place in the country over, let's say, the past 2 to 3 weeks. And it's a quote that it's attributed to a guy in history called Shtarek Muj, Gaspadin Ulyanov. That's the way the Soviet people fondly referred to Vladimir Lenin. So Lenin once said there are decades where nothing much happens, and then there are weeks where decades happen. I think that pretty much sums up what has been going on in the country. The strong anti-government, anti-tax protests, which of course have been led by the Gen Zs in Kenya. And other groups have joined the chorus, including millennials, baby boomers, zennials, and pretty much every other age group in the country. So the economic outlook of the country looks really dim, to be honest. A couple of key economic events that have taken place over the past, say, 2 to 3 weeks, which began with the shelving of the finance bill, even though the appropriations bill was signed into an act, so that we now have the Appropriations Act. However, the shelving of the finance bill was followed recently, just last week on Thursday, by the firing of almost the entire cabinet, save for the Prime Cabinet Secretary and, of course, the Vice President, who is also a member of the cabinet. And besides that, sometime early last week, the credit rating agency Moodys actually cut Kenya's creditworthiness from the B level it was into the C level, which means Kenya will be facing much more difficult prospects when it comes to trying to borrow in the international markets. And I think they will continue to shape and influence the economic outlook of the country in the coming months, but also in the coming years, for the next 2-3 years, especially as we run up to the 2027 elections. And since Moodys has downgraded Kenya's credit rating, I don't think it's really far-fetched to think that following quite quickly behind will be the two other horsemen of global credit ratings, that is Fitch and S&P. And probably they will also downgrade Kenya's credit ratings, which is a very integral part when it comes to international borrowing and lending. So how will the Kenyan economy actually proceed ahead? If you look at some of the key economic metrics like the levels of inflation had actually beautifully anchored over the past, let's say, 6 months. And I think the latest figures had it at about between 4.5 and 5%. That's the headline inflation. And then the food inflation was slightly higher than that one. If you also look at a macroeconomic indicator like the strength of the currency, the local currency, which is the Kenya shilling, it had drastically improved over the last 4-5 months, especially in the wake of Kenya issuing a new Eurobond, part of whose proceeds were actually used to pay Kenya's first Eurobond, which was issued in June 2014 and was maturing just late last month, exactly when the anti-government, anti-tax protests were actually at their peak. So the shilling had stabilized quite nicely, inflation had anchored, and who knows how things will unravel from this point on. I mean, there is the aspect of firing the entire cabinet, which is a signal to the international markets, but also locally that the government is trying to do something here when it comes to wastage and opulence and excessive spending, and that the government might take a course of austerity, which might end up improving the economic conditions of the country. On the flip side, such moves can also signal instability and might make foreign investors quite wary. And so how could that actually impact the stability of the Kenya shilling at the moment, which is about 128, 230 against the greenback? Is there a possibility that the strong depreciation of the Kenyan shilling that we saw, let's say from February going backwards to, I think, mid last year, where the shilling continued to be battered by most international currencies, the euro, the yen, the renminbi, the sterling pound, and many other currencies? Is there a possibility that because of the current tumult, protests, and the negative economic market sentiments that they may have produced, that the Kenyan shilling may actually go back to the situation where it was depreciating quite strongly. Because again, there is always a lot of capital flight that takes place when there are issues in most global south countries. A lot of money, especially in dollars, leave the frontier markets, as we are sometimes called, and they go to safe haven markets, especially, let's say, in the US, in US Treasury bills and securities. And if one factors in such kind of a scenario and what we have seen in the country over the past 3 weeks, then it could also signal that the Kenyan currency might once again be facing headwinds over the coming months and also maybe in the next 1 to 3 years. The issue of debt is, I think, a very important one when it comes to the current economic outlook of the country. It was slightly early last month when the IMF board met for the 7th review, and they had actually agreed to disburse the next amount to Kenya, which was, I think, coming to about 976 million US dollars. Kenya being under a multi-year IMF program since 2021, which is actually supposed to sunset sometime in mid next year, 2025. Now, there are a lot of jitters at the moment about whether the IMF is actually going to disburse that amount, whether it will require that the government take measures and steps to actually prove that it will be able to raise more revenue and that it will be able to implement the austerity measures which the president has hinted at. In the April annual economic outlook of the entire world and all the countries that are members of the IMF estimated that Kenya's debt to GDP ratio at the moment is about 73%. And the question then comes in because the president had also mentioned something about shelving the finance bill means that the country will have to increase its borrowing. But then, how are you going to borrow when, first of all, the international capital markets, to be honest, are completely outpriced for Kenya at the moment? If you look at the bond yields, which are way above 10%, it means the country will really struggle to find access in the international capital markets because of the tighter financing conditions, the degrading of the Kenyan credit rating, which just happened a week ago. So going to the international capital market seems to be a really tall order. On the flip side, going for syndicated loans from commercial banks, even across Africa, will also become a tall order, I believe, because most of those commercial banks will probably follow the same path that the IMF or other international lenders, like the private capital market lenders, in the case of the Eurobonds, usually do. So if Kenya is outpriced from the international capital markets and it can also not access or tap into syndicated loans from commercial banks, the only other option that may be available for the country will be increasing domestic borrowing, which, to be honest, also takes a much substantial share of Kenya's national debt. I think at about 52% compared to foreign borrowing, which is about 48%. However, more domestic borrowing always means that the SMEs, companies and businesses, as well as private consumers, are actually crowded out when it comes to accessing capital from commercial banks, because a lot of Kenyan treasury bills and bonds are usually bought or invested in by commercial banks. And it's the same banks that are supposed to be lending to the private sector, to the private economy, the MSMEs, private businessmen, entrepreneurs, and so on and so forth. So there is a possibility of the private sector being much more crowded out in terms of accessing the much needed capital to increase the economic productivity of the country. A recent development, though, that might also temper the notion that the country will increase domestic borrowing has to be when the central bank issued a treasury bond 2 weeks ago or something of the sort, and the country was aiming at raising about 20 billion Kenya shillings, which translates to about 150 million US dollars. Now, at the end of the sale, the country only managed to raise about 450 million Kenya shillings, or roughly $3.2 million. So the country was aiming for $150 million and only managed to get $3 million in the domestic market. And that probably also reflects the apprehension that domestic lenders, especially commercial banks, have when it comes to lending out to the government. So if that won't work as well, if borrowing in the international capital markets won't work, and borrowing from a syndicate of banks won't also work on the African level, and thirdly, borrowing from commercial banks locally also won't be a feasible option for the Kenyan government, what are actually the alternatives that the government has to raise financing? It appears that there is only one way they can try and do this, which is also going to be a very bumpy road, and that is trying to restructure Kenyan debts. That might be the only way out, especially when one looks at the situation that the country finds itself in. Debt restructuring is not quite easy. A lot of Kenyans' loans are owed to China, and a huge number are also owed to international lenders, especially the Eurobonds, which are owed to private lenders. Restructuring them will not be an easy task. For the Chinese, they always insist they won't do any restructuring, and that one also poses a dilemma, an existential quandary of sorts for Western development partners, because for them, they always insist that if China is on board, we are on board. One could almost refer to this as the "I'll only do it if you do it" syndrome. Like they'll only do the debt restructuring if the Chinese are on board. But the Chinese are known for their non-Paris debt clauses, where they always argue that if there is to be any debt restructuring, it will be done on a bilateral level, not on a multilateral engagement like the DSSI, for instance, the debt suspension initiative that was implemented by the Paris Club or the G20 group of countries during the COVID pandemic period in 2021. And when we talk about the China versus the West rivalry, even when it comes to debt restructuring, we have seen it quite openly in the case of Zambia and also in the case of Ghana, where there has been a lot of back and forth rolling into 2-3 years down the line with the establishment of the OCC, the official creditor committees, and trying to find a debt restructure for Zambia, but also for Ghana. So that might look like a solution on paper, but in reality, it might be a very bumpy road for the country to take. Aside from that debt restructuring, the other option that may be feasible will be for IMF to actually extend the current program, which is a multi-year program started in 2021 and is supposed to sunset in 2025, whether that could be extended for maybe 1 more year or, I don't know, for 2 more years. Now, the only downside to it is the IMF will probably even harden the conditions that they will give to the Kenyan government, especially when it comes to raising more revenue, when it comes to trying to tap more into the informal sector and bring more of the informal sector into the overall tax base of the country, and ergo to widen the tax base. They might also harden the conditions when it comes to subsidies, which of course they are always strongly against, as well as tackling corruption and money laundering. And if the government of the day is willing to actually toe the line and to actually follow those conditions, then there's a possibility that the IMF might extend the multi-year program that it has currently been having. However, that remains to be seen. Maybe it's an option, maybe it's not. Maybe it's an option on paper, but on the ground, as we always say here in Kenya, the reality might be very different. The reality on the ground is always different to what we have on paper. And having looked at the overall macroeconomic conditions that might shape the economic outlook of the country over the next months and years, one could also shine the light quite quickly on the other side, which is foreign direct investments. With the current climate and the way things are, it could be that foreign direct investments will even continue to slow down much more than we had in the past 2 years. And that might reflect the overall international investor confidence and sentiments of how the country is being viewed. With slowing FDI inflows, with difficulty in accessing international capital markets, I think the economy will really need to pull a rabbit out of the hat in terms of the policies that will be put into place and also the political goodwill that will be needed to actually change the course of the economic ship, which to some people might be headed towards the rocks, and that there is a possibility of a major economic shipwreck. Because at the end of the day, in all the options that have been mentioned, one cannot wish away the fact that a sovereign default may always be on the cards. Thanks for watching. Bye.